Well, hello everybody. Ron Wheeler here, manager of options trading at VectorVest, and it's my pleasure to bring you this special webinar called 5 Steps to Generating Income with Options. So let's start right off the bat. What do you mean by income? Well, to me, an income trade or trading for income is setting yourself up in a trading situation where you can win even if you're wrong on direction. So if you buy 100 shares of a stock, doesn't matter what stock it is, the only way you make money is if it goes up. Well, what I want to do is I want to take that same stock that you think is going to go up, but put a trade together where it can go up, you make money just like you thought you would. But now it can go sideways or even down. And that's what I want to talk with you about this evening in this presentation. Now, why is this important? Why is income so important? Well, our goal at VectorVest is to help you be free, finding financial freedom. And financial freedom is simply like this. You have to have a way to generate income from your existing investments or capital. The money that you already have needs to be out there generating income. And when you can do that, that is a fulfilling freedom in your life. Now, one of the best ways to do this is using options for income. And I firmly believe it can change your life and set you free. Using options the right way, you can make consistent income each month. And by that, I mean conservatively 3% return each month. Now, why doesn't everybody already do this? Well, most people are afraid of them. They're afraid of options, right? You might be even tempted to stop watching because, I'm talking about options. Why are people afraid? Well, you might have been told they were risky, or you needed a lot of money to trade them, or you needed a lot of time to do it, or maybe you find them confusing or difficult. That's all false. I can understand it, but I really think it's because you haven't been taught the system or even a system in a way that makes sense. Now, here's the thing. You don't have to be afraid of them. Now, here's some of our clients who are just like you. They were in your shoes at one point, and they've changed their lives by learning how to use options correctly. And remember, these are real people just like you. Now, in order to do that, to get yourself into their shoes now, you need to avoid the common mistakes that people make. And perhaps you've made them as well when it comes to using options, and especially options for income. As we go through these, we're also going to talk about how you can immediately fix them. And at the end, I'm going to show you my 6-step system I use that helps me trade options for income. Now, mistake number 1 is simply being on the wrong side of the trade. If you're trying to generate consistent, reliable income as an option buyer, well, you're just on the wrong side of the trade. Now don't get me wrong. Option buying has its place, especially if you do it the right way, but most people don't, and you're going to take advantage of that. Most option buyers have a buy and hope strategy. If you're buying and hoping that things will go up, you're basically gambling. And this is a big reason why people give up on trading options. But if you have a system based on selling options for income, you can reliably generate monthly income. And instead of losing more than you win, you can turn that around and have a 60+% win ratio. In fact, some of our clients are even in the 70 and 80% area. Now, I want you to think about it this way. You like a stock, you think it's going to go up, right? A stock can go up, but it can also go down, or it can even go sideways. Now, let's say you buy a stock or you buy a call option. In order to make money, that stock needs to go up. That means out of those 3 scenarios, the option buyer makes money in only one of those. Okay? That also means that the seller of the option could make money in all 3 of the scenarios, right? If the stock goes up, you're still going to make money. If the stock goes down, you have an area in price that you can still make money on that trade. And if it goes sideways, you still make money. The option seller can make money in all 3 of these scenarios. Now, for those of you that are not familiar with options, I'm going to give you a quick kind of tutorial about what options entail. There's 3 parts of options that we're going to talk about. There's the expiration date, there's a strike price, and there's a premium. In other words, the price of the option. Now, in every option trade, there is a buyer and there is a seller. Now, as a buyer, the expiration date works against you. you have to be right by a certain date. And every day, a thing called time decay eats away at your options. Now, the strike price is something you need to overcome. The stock you pick has to go in your direction for you to be right and make money. So if you buy a strike price way above the current price of the stock, you have to overcome that to make money. Now, the premium is something you pay to someone else. This is money out of your pocket, and you are right back to buy and hope mentality. Now, as a seller, the expiration date works for you. Every day that goes by is more money in your pocket. And I want you to think about being an option seller like this, right? You've all bought cars probably before. You buy a new car, you take it off the lot, and immediately it loses 30% of its value, right? That's basically the same as what we're going to try to do with options. Our goal is we're going to sell an option, but we have to cover that trade or exit that trade later. So I'm going to sell an option. I'm going to choose a strike that's easy to avoid, right? Basically the stock price. And I'm going to get paid a premium. Now, when I get paid that premium, what's going to happen is every day that stock trades and that strike price that I sold hasn't been hit, I receive premium. I'm going to make money. And later on, I can close that trade at a lower price. It's a little bit different. It's complete opposite, in fact, as when you're a buyer, right? When you buy something, you want to buy it low and you want to exit high. As a seller, we're going to enter at a high price and then exit the trade later at a much lower price. And we're going to keep the difference. But the key takeaway here is this. Being the option seller is what's going to give you income. It's going to give you that high probability of success for trading. Now, I'm not saying you should just go out there and start selling options and money will just fly into your bank, right? I'm saying learn to sell options correctly. Start the trade with an immediate advantage. When you sell options the right way, you're going to start these trades off with a minimum of a 60% probability of success. Now, keep in mind, there's more to the system, which we'll talk about when we get to the mistake number 4. We don't want you to just go out and start selling naked options. But at this point, I just want you to understand that you have a higher probability of success as an option seller. Now, one of the best baseball players of all time is Tony Gwynn. Not because he hit a lot of home runs, but because he got a lot of singles and doubles. He hit for a high average. When you always try to hit a home run, most times you swing and miss, and then you strike out. Most option traders are the same way. They buy these cheap options hoping to hit a home run. And what ends up happening is they suffer loss after loss, and that eventually drains their portfolio. Now, here's a great picture of a graph of take two. To get the cheap options, what they typically do is if they think the stock will go up, they buy a strike price way above the stock price, right? Stock's trading for $258. They go up to $277 and they buy a call. Well, remember, you're not really going to make any money unless you overcome that stock price. Now, if you're setting yourself up for failure right from the beginning, why do people do it? Well, they do it because that option up there is inexpensive. It doesn't cost a lot. It might cost me $1,000 to buy a call on this stock. But if I buy it way up here, it only might cost me $60 or $100. What we're going to do is we are going to sell those calls. They are buying a very low probability trade. We are going to sell them a high probability trade for us. Now, the same is true for puts. You might go way below the stock because you want to buy a cheap put because you think the stock is going to go down. Or who knows, maybe you own the stock and you're trying to protect your position. It doesn't matter. It really doesn't matter. We're going to find these options that have a 60% chance or higher of working for me. We are going to essentially take the bet of that option buyer. He's got a low probability scenario. We are going to give ourselves a 60% or better probability right from the start of the trade. And that really is the key takeaway. We're going to start by selecting strikes that have probabilities of less than 60% of getting hit. Now, mistake number 3 is not having protection. Remember earlier I told you we didn't want you to just go out there and start selling options naked? Selling options naked means you don't have a way to limit your risk. It means there's no other trade along with it to protect it. And if you sell options naked, then you take on more risk, which we don't advocate. We want you to be risk adverse. So instead of selling an option naked, you should buy an option along with it as a way to protect it and limit your risk. I want you to think of this as like an insurance policy. Now, this is an example. Now remember, the system you use ultimately determines how you reduce risk, and all of this is actually done before you even open the trade. The first thing is we want to choose stocks that are very low risk, right? We want to choose stocks that are going up and up trends and down trends. Then once you do that, instead of selling an option naked, we're going to sell it with protection. So let me show you how to do this. This is a graph of take two. Again, it doesn't matter what graph it is. I just want you to kind of understand the concept. When we think a stock is going to go up, the stock's at 258. We are going to go underneath the stock, in this case down to $250, and we are going to sell a put. Why 250? Because 250 gives me at least a 60% chance of success. That means over the next 21 to 45 days, really over the next 10 to 20 days, the stock has to stay above 250. That's it. It's an $8 cushion for you to be wrong. Now, when you sell that option, you're going to get paid to sell it. You're going to receive a premium. Then what we're going to do is we're going to take that premium, go down a little bit farther, and we are going to buy a put as insurance. Now, what that does is it leaves the trade a couple things. Number one, you're not naked anymore. You have protection. Now, I'm going to explain to you what happens in the event of options expiring. What can happen if you let a trade expire, which we never do? If you sell a $250 put, you may be obligated to buy the stock at $250. So if the stock goes down to $200 and you're forced to buy the stock at $250, that's what I'm talking about, a massive loss. But we now buy a $245 put as insurance. That means you can go out and sell your stock for $245. If I'm forced to buy it at $250, I can sell it at $245, limiting my risk to $5. No matter what the stock does, if it goes down to $0 a share, you are limited to a $5 risk. Now, don't get worried about that. In 15 years of option selling, I've never actually had to perform that kind of transaction before. And you might be asking, well, Ron, if you've never had to do it, why are we buying insurance? We're buying insurance for a lot of reasons. Number one, it reduces the risk of the trade significantly. It does give you that downside protection just in case. It reduces the amount of margin. You could do this trade for a couple $100 in your account. Also, it reduces the amount of option experience you need with your broker as well. A lot of brokers don't like newer traders selling options naked. And that 245 also acts as a small hedge. So if the stock does go against you, it actually offers a little bit of profits that you can make to help offset it. So the takeaway here is simple. Use those spreads. This happens to be called a credit spread, a bull put credit spread. Why bull put? You do it when the market's bullish, we do puts, and it's a spread because we have $5 different strikes. Now, mistake number 4 is simply not putting time on your side. This is like if you go to the grocery store. You see a piece of steak discounted. Usually it's discounted because it's going to expire that night or maybe tomorrow. And if you don't cook it, it's going to spoil. I don't know, maybe you're a risk taker, right? Hold it in your fridge for a week. Doesn't matter. It spoils, so they have to put it on special. Well, options are kind of the same thing. The further and further out you get to expiration, and you can kind of see that in the upper left-hand corner here, that right there is 6 months to expiration. But you can see as expiration gets closer in the lower right, that the time value of the option is slowly starting to eat into the value of the option. And it slowly eats into it until it gets about right here. That's 45 days to expiration. Then you can really start to see that expiration getting closer and the premium getting exponentially more and more decay. Okay? A lot of buyers, they like to buy their options really, really close to expiration because the premiums are a lot cheaper. But by buying there, you're going to make it so the option loses all of its value before the stock has time to go in your direction. So what we're going to do as sellers, we're going to sell it in that window. And to be more specific, we're going to sell our options 21 to 45 days away. That's going to have enough premium to make it worthwhile from a risk perspective and close enough to the expiration to where that time decay is really in our favor. So again, our key takeaway here, Sell options 21 to 45 days away. It's as simple as that. We're going to look for more than 60% probability of success in our favor, and we're going to use 21 to 45 days of expiration. Now, the fifth mistake is that deadly combination of greed and hope. Now, on one hand, you have greed, right? A dangerous thing option sellers say is, I'm up 50% on the trade, and if I just hold it a little bit longer and let it expire, I can make the full 100%. One of the worst feelings is to watch a profitable trade turn around on you and eventually close it for a loss. Now, on the other hand, you have hope. An option seller will see a trade going against them and they'll say, hey, probability is on my side. I'll give it one more day. It'll come back. But when it doesn't, they watch a small loss turn into a big loss. So our key takeaway here is very simple. Exit or set your profit target immediately after you enter the trade. We are looking for a 50% profit target. That means if you enter the trade and you get paid $1,000, we would exit the trade when we can keep $500. So when I enter the trade, I get paid $1,000. I'm going to exit the trade later on by paying the broker back $500. And then I keep the remaining $500. Why do we do this? Because history has shown that's the sweet spot of being an option seller. This is where you're going to make the most money and you're going to have the highest success rate. I know it sounds unbelievable. Ron, if I stay for 75% of the profits, doesn't that mean I make more money? No, because you're giving the trade more time to go against you and it reduces your probability. Okay? Also, we're going to exit if the stock price goes against you and hits the option price you sold. So let's take an example of these. This right here is the trade on take two. I'm selling, and you can kind of see it in the upper left-hand corner, I'm selling a $250 put, and I'm going to receive $8.45. Now that's, remember, options work as, when you see the premium, it's one share of stock. One options contract is 100 shares of stock. So if I were to sell that $250 put, I'm going to get paid $845. By buying the insurance, I'm going to pay $670. That's going to leave me with a premium of $175. So when I take this trade, I am going to get paid $175. That means, and you can kind of see over on the right-hand side the risk profile of this trade. You can also, and most brokers have this as well, by selling that $250 put on take two, look at the probability. The probability of this trade working against me is 31%. That means I essentially have a 68.7%, if my instant math is correct, of this trade working for me. That's the probability. And again, most brokers have that. You're seeing this with Options Pro, our software here at VectorVest, right? So this trade has a maximum profit of 175 and a maximum risk of 325. Now, I want you to take a look at this risk graph. Now, don't get intimidated by a risk graph. It just shows you what your profits and losses will be as the stock goes up or down. If the stock goes up, you're going to see that line pointing into profits. If the stock goes down, you're going to see the line going into loss. Now, a $325 loss, if I followed this dashed line all the way down, if the stock drops to $232, I'm only down on this position by about $200. Okay, so for this to have a $325 loss, the stock would have to go down 50%. And we're not going to let that happen. Okay, so when you look at the max profit of 175 and the max risk of 325, that's not exactly what we're looking for here. Okay, we are essentially looking for an $87.50 gain. Why? Because remember, when we sell the position, $175, we're looking for 50% profit. And if you follow the risk graph, that's going to occur when the stock goes up to about here. Look how far it has to go up for you to make all $175 of that. Now, the real risk of this trade is if the stock were to fall below $250. And that real risk on this trade is only $60. So you're going to make $87 on this trade. You're going to lose potentially $60 by exiting before we get to $250. Now, if the stock takes its time to get to 250, you're still going to make money on this trade based off the decay. But if before that happens, you can lose up to $60 on this trade. This trade would only cost you about $500 to place. Now, for some of you with larger accounts, you're going to probably do it this way. Instead of doing one contract, you may do, let's say, 9. That'll generate about a $1,500 credit. Your goal will be to make about $750. And to do that, you're only risking about $545. This is the type of trade scenario that you want. One bad trade will not wipe out a bunch of winners. And that really is the key principle here. All right, I told you at the beginning, at the end of the presentation, I'd walk you through my 6-step system that helps me generate income with options. Let's take a look at that. This is what we call the options paycheck income system. And it all starts at the top with market direction. With market direction, I'm going to be looking only for bullish or bearish trades. Bullish when the market is up, bearish when the market is down. So to do this, you need a way of determining market direction. We have a great timing system we use for our paycheck system. It'll tell you whether it's time to trade bullish, bearish, or not trade at all. Once we have the market timing down, we go to stock selection. We want to choose stocks, not that you know, not that you've traded before, but stocks that are going to go in the direction of the trend. So stocks moving up when the market's moving up, stocks moving down when the market's moving down. We use 2 primary principles for this: fundamentals, things like earnings per share, growth rate, industry performance, and then we use price trend. We look at the graph. We want to make sure the graph is going up or going down. Next, option selection. You want to have a list of stocks, and really you want to find the best ones for trading. Now, I talked about how we select options to sell. One of the things we didn't have a chance to talk about tonight is volatility. I want to make sure that options have very high volatility to get those premiums very expensive. The more money we can sell the option for, the less risk we have in the trade. We also take a look at earnings. We want to make sure that they're, over a period of time away. I don't want to have an earnings announcement when I'm in my trade. And then I also make sure my expiration date is in that sweet spot, that 21 to 45 days. Setting up the trades. We're going to pick the one that has at least a 60% probability of win based on the strike prices, kind of like I showed you on that risk graph. But we also have to maintain the proper risk reward. I want to make sure that my winning trades are going to pay for my losers, or they're going to be very, very close. We also want to talk about trade management. Now, this is very critical because trade management is something that needs to be done before the trade is placed. Before you go to your broker, I want you to know when to take profits. I want you when to know if you need to adjust or repair the trade. And then also when to exit with a loss. I don't want you sitting in your trades, feeling like frozen like a deer in the headlights because you don't know what to do. And then lastly, you want something that's going to be efficient, right? Tools for speed. Brokers have great tools for this. Some are very good. Thinkorswim's very good. Interactive Brokers, E-Trade, TradeStation. But you want something that's really designed to help you get to this as quick as possible. We have some great tools from VectorVest that are designed to really, jump out at this and make this as quick as possible for you. Now, this is the system that I use every week with my live coaching clients to find these income trades. And if this is something that you're interested in, we teach this in a course called the Options Paycheck Experience. This is the most comprehensive program you're ever going to find for generating income on option spreads. It's because we teach you exactly how calls and puts work. So if you've not traded options before, we're going to teach you the calls and puts. We're going to teach you what terms you can pay attention to, which ones you can ignore. We're going to give you clear signals telling you when to trade, bullish, bearish, or even not to trade. We're going to quickly identify those stocks that are the best candidates. That's why this is such a thorough course. We're going to teach you the market timing, teach you the stock selection. We're going to help you set up income trades that can give you a 70% better success rate, right there with like that take 2. You're going to have a trade management game plan in place prior to entering your trade. And then you're going to be able to confidently enter and exit trades with your broker. Most importantly, when it's all said and done, you're going to implement a system to safely and consistently generate income. The course is 8 modules long, and every module builds on the one prior. We start in the beginning with giving you a good option income foundation. That way you know how to use options correctly. teaching you the basics, teaching you the spreads. Then we start doing the trades themselves. In module 3, teaching you market direction. 4, picking the right stocks. 5 and 6, making sure your option trade is perfect. Got that perfect balance of risk, reward. You're going to know exactly which options to use. Module 7, making sure that you're not going to have that one bad trade that wipes out a bunch of winners. And then finally in Module 8, we'll even talk about the execution on the broker side. Now, if it looks intimidating, we offer you a step-by-step checklist for this. So you can go right through the checklist, right down the line, making sure that everything is done properly. And in fact, this checklist is now on a spreadsheet. The spreadsheet does the math for you. It'll tell you how many contracts to trade. It'll tell you if the risk is too high. Everything you need so you're comfortable when you're starting out. We also, for some of the brokers like Thinkorswim, we have step-by-step guides to help you place orders. For some of the other brokers like IB, Fidelity, E-Trade, we also have some guides as well. Now, the course has a 100% money-back guarantee. You can go through the entire course. If you don't find that the course is working for you, or you didn't get what we promised, all you got to do within a week of finishing the course, just let us know, and we can give you your money back. It's as simple as that. Now, I want to share with you just some results from this year. I do a live coaching plan, and I just wanted to show you kind of what my returns were for the year. So I will tell you that, I've placed 60, I'd have to add those both up. It's like 108. I've placed 108 stock trades this year, 63 wins, 45 losses. My win rate's down a little bit this year, mainly because of the volatility of the market, but that doesn't matter. My average win is about 743. My average loss is 732. My average days in trades, 9.6. And I'm up about 13.8% for the year. That's based on $100,000 in capital that I set aside for stocks. Now, of that $100,000, I set aside $50,000 for the S&P 500. That's another part of our system. That one, I've won 23 trades, lost 20. Little low win rate this year again. 14% average, or 1,400 average win, 1,200 average loss, average days in trade 3. So that's kind of like a weekly trade, as you can see. And then up 14.2% for the year with a $7,600 profit based on that $50,000 in risk. So, if I had done, 100 on both of them, you would see kind of a little bit difference of a much higher number here, but because I do a little bit lower. So perfect. This is 28% return. Our goal is to help you make 3%. That's our goal. And that's what we do by teaching you the options paycheck system. So if you're interested, we give you also a mastery package. The course is taught starting Tuesday, October 28th. Hey, that's going to be a welcome session. And then we're going to teach you 2 modules a week for the next 4 weeks. During those 4 weeks we teach you the modules, you're going to get a mastery session. That means a mastery session for each module. They take about an hour where we're going to go over the key principles with you, do the assignments, make sure you're understanding. And then on Fridays, we wrap it up with a Q&A. You're also going to get access to our dedicated email that goes directly to me and the Options Paycheck team. That way you have direct line support. You're also, if you don't have it, going to get access to both VectorVest and our Options Pro software. That's the software you saw earlier where I did the risk graph in. Is it required for the course? No, but we are going to give you a trial for that for November and partially way through December for the live curriculum. We're also, at the end of November into December, going to invite you to our live trading sessions. This is where I did those trades that you saw. This is where we implement everything that we do. You're going to get a live trading session, actually 3 live trading sessions a week, brought to you by our office hours as well. These are going to teach you the system and repetitively go over the process over and over. Now, if you like the SPX, because that's a very simple trade, 15 minutes a week is all it takes. You saw I basically traded 43 trades this year. It's already got a 14% return. One symbol, one setup, one profit rule, one stop. Very quick and simple. It's something you could be up to and running in within an hour. It really is that simple. So total package altogether, all of the things that you need to get this implemented into your portfolio as quick as possible. Total value of $54.75. What we're going to do for you, if you order before Tuesday, October 28th at 10 a.m., that's the cutoff of registration. We are going to give it to you at our lowest price possible of $9.95. All you got to do to join, go to optionspaycheck.com. Hey, 2025 is closing. This is a great way to learn something new, implement it as the new year starts. We've been doing this class now for about a decade here at VectorVest. We've got thousands of clients who are very happy with it. We have tons of students in our coaching who implement this every week. I want you to be one of them as well. Join me next week. Join me in the Options Paycheck and let me show you how to create a successful income portfolio. Thanks again, everybody, and I hope to see you in our live Options Paycheck class. Thanks again.